This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, and it just turned 8 p.m. Eastern Time. I like to start on time. I like to end on time. I respect your time attendance tonight. This is our monthly open house Q&A. It's free to our members, and for those guests who've been invited to attend, to give you a little sample of our culture and what we do at the Market Guys with regard to financial education. And as I said in the warm-up to the call, the technical signals that I'm seeing on these candle charts have been the most accurate and reliable signals that I've seen in over 33 years. My 34th anniversary will be August 15th of this year. And for those of you that don't know my background, when I started trading, we didn't have computers. We had the old style point and figure charts where we had graph paper kind of rolled out in scrolls, and we did have sharpened pencils in our pocket protectors. We looked like a bunch of nerds analyzing the trade screen, and even back then technical analysis was very reliable. But what's happening is the audience is growing, and I'm going to start on this note because this point that I'm going to make drives the fundamentalists absolutely crazy, because the old style analysts would look at the fundamental reports, they look at earnings, they look at earning forecasts, they look at PE ratios, they look at debt to equity ratios, they crunch those numbers, and they would leave the charts to the wayside. They really didn't put that much weight into the technical signals. But what's happened, again, thanks to the advancement of technology, technical analysis has become the leading tool for not just forecasting the market, but for risk management. And here's why. When you have total transparency in the market, and you can now see the times or the days, even down to the hour, when institutions start bidding up the market on high volume, that transparency causes a chain reaction of people to more or less have that mass group mentality. And when buy signals start to show up, the masses react to the buy signals. And when the sell signals show up, like we saw here in NUGT, just using this as an example, if you look at NUGT, just a couple of days ago, we had a very long red candle here on fairly high volume. Well, there's a clear signal that the market opened and then got trashed for most of the trading day on high volume. That's a sell signal, no doubt about that. So what's going to happen? The masses, the investors like you and I, come in and we say, uh-oh, sellers are moving in. Let's not buy today. Well, that's half the equation. I'm not going to get into short selling, but when there's a massive sell signal that shows up, people tend to shy away from their buying activity, and that allows the prices to drop because there's lack of supply at that particular point in time. And the opposite is true for buy signals. When you see a bullish engulfing pattern, or you see a harami or something bullish like a hammer. See, back here we saw a candle. It's a hammer pattern. The buyers tend to jump in on that signal, and again, the masses react and causes price to go up. And in this case, the hammer pattern resulted in gap trades higher, gap up, again, gap up on increasing volume, and people react simultaneously. So when I teach about technical analysis in its most basic form, I also tell people, go and tell as many people as you can about the accuracy and what we're seeing here. Because if you can get more people to react to these signals because they're more aware of them, if that's the worst case, they're at least aware that it's happening. They too will join in on the party, and now we have precise movement in the market based on these signals. It's kind of like if you're in a traffic jam, right, and it's gridlock because you got the gridlock in the middle, and you're in a grid line there, and all of a sudden you got a traffic cop trying to straighten out the mess. The traffic cop is going to give the signal, okay, press on the gas, folks, let's go, let's go. Traffic starts moving. That's what happens when you have a bullish engulfing pattern. You might as well put a green light out into the market. Okay, it's good to buy now. Okay, 1, 2, 3, everyone buy. What's going to happen? The reaction follows of the buying activity, and we all make money. So again, tell as many people as you can. Now, what I'm going to do is I'm going to do a quick market analysis based on what I put out on the weekly market report from last Friday. For those of you who are subscribed to that, I'm going to show you, this is the actual chart that I used. Why isn't my chart expanding there? Okay, there it is. This is the actual chart, and I left my lines in place. Here was Friday. See the hammer? Well, it's pretty close to a hammer pattern. But on Thursday, the diamond showed this beautiful bullish engulfing pattern. It's a big, long green candle that follows a smaller bodied red candle. And when you have this 2-day combination in place, like I said before, that's the green light to buy. Now, on Friday, it didn't have a higher high. We had a higher low. That's called a half signal. When you have a higher low than the previous day's low and a lower high, at least you have half the signal there, or another half signal could be a higher high, maybe not necessarily a higher low, but a higher high. That too is a half signal. And when you have a long shadow underneath the candle, that's usually bullish. And you see here, there's a long shadow beneath this candle on Friday, so a long shadow underneath the candle on Thursday, and then you had one on Tuesday. Here, long shadows under the candle is very bullish. So the pivot point formed. So on Friday, when I put out the report, this is the line that I drew. Isn't that interesting? I said that we would move up, and look at where my line ended. Right there. Right at, let me see, it ends at 179.07. Today's high was 179.23, almost to the penny on the first day of the week. We hit my price target. Isn't that amazing? Now, I'm not going to put out the next weekly market report until next Friday, but I can tell you, all that you're now on the open house, this gap up is something you have to watch out for. Gaps act as a price magnet that draw prices back to the gap point. Now, there is a good chance we could go a little bit higher, maybe over the next couple of days, but eventually I think we're going to come back to fill this gap. And if this gap is not filled by Friday's close, I will then report on the fact that that gap will most likely close, and that will act as a magnet. So you can see how I'm using the technical signals to forecast. And this is not just in the diamonds, it's throughout the market. Here's the S&P through the spiders. This is the S&P ETF, SPY. And again, there's my lines. You can see that for the S&P, I said that we would move higher. Again, I have a little bit of a delay here. I don't know why. Let me just try to get that moving. There we go. So let me expand that chart. Let's see. There it is. So here is my forecast, and we could see a little bit higher because there's a gap above the market, but again, it reacted perfectly to what I had seen on Friday. So again, you can take these techniques in basic candle charting. You'll see I don't have anything else on my chart. There's no Fibonacci numbers. There's no Bollinger Bands or RSI and stochastics. There's none of that. I mean, we could talk about those things, but in my opinion, when you're looking at raw data, price and volume being the most important, that is going to give you the most accurate signal. And you can see, even on a broad-based index like the Russell 2000, again, I left my lines on here as well, you'll see that the Russell 2000, there's a little bit of delay there as well, pardon me, I said that we would bounce, and again today we came right up to that, very close, almost to the penny, to my target area right there on the Russell 2000. Finally, let's look at the Qs, QQQ. That's the NASDAQ market, and then I'll talk about the VIX before we get into the meat of today's content. The Qs I didn't report on last week. I left my lines from the previous week online, and you can see that those numbers were hit as well on the power shares. So the NASDAQ market, again represented in QQQ here, this is an index that basically mirrors the NASDAQ market. You can see that there's still a small gap above the market that could actually be filled. Now, if I look at the VIX, this is the volatility index for the CBOE. I did put my forecast out on Friday for the VIX. And interestingly enough, I said that my belief was we would come back to fill the gap, on the downside. And what happened today is that, I'm trying to zoom in here, forgive me, there it is. Here's the gap that I was referring to on Friday, with this doji here being Friday, today obviously Monday. What happened? We came right down to the gap. This was the line that I drew as my gap fill support. We filled the gap, and now there is an 80% chance that the VIX will start to move up. Now let me hit the pause button here and explain to you why this is so important. Whether you follow the VIX or not, please understand that many hundreds of thousands of people, both amateur and professionals alike, follow the VIX. And the rule for gap trading is that, number one, there's an 80% chance that a gap will fill. That's rule number one. Rule number two is that once a gap fills, there's an 80% chance that the gap will reverse. The price will reverse from the gap. And hence the reason why I said we would come down to fill the gap. These are my actual lines from last week's report. We filled the gap. Now look at this long shadow. Remember I talked about that when we were looking at NUGT. When you see long shadows under the candle, what that means is that the sellers tried to push it down to that low, but the buyers came back with force and muscled the price back up. So this tells us that the battle occurred, but the buyers won out in that particular battle. Now, remember what I said, the VIX is a contrarian indicator to the S&P. So if all of a sudden this gap fills, there's an 80% chance that the VIX will start to rally. What does that mean for the S&P? It means that the S&P could start to move lower. And that's why it's important for you to keep the VIX on a watch list to keep an eye on that. Now, if you want to trade, the VXX is the short-term VIX ETF. You can trade this. It's the Barclays Bank iPath S&P 500 VIX short-term ETF. And you can see that the VIX, through the VXX, has a hammer pattern there. Now, interestingly enough, my niece's husband, I guess you could call him my nephew through marriage, decided he was going to trade. His first trade was actually in DUST, which was it's the contrarian bear market for the gold market, and he made money. His first trade, he bought it at 10.05, sold it at 11.03 today. First trade, almost, you got to be careful, because when your first trade is the winner, that almost could be a curse, because now you think it's easy, right? But his second trade, he got in on his own. He didn't ask me, what do you think? He jumped into VXX because he learned from my videos on gap trading. Now, there are some people that trade gaps as a strategy, and that's all they stick with. So the VXX gapped down and formed this perfect textbook hammer pattern. Now, it could still go a little bit lower here, but he got in right at 14.05. I'm sorry, he got this on this one at 14.20, and there's a good chance that it could rally up at least $1 to fill this gap. Now, to make $1 on a $14 stock is not so bad. Now, the other good thing about trading the volatility index through VXX is that the VIX is an oscillating indicator. It's not a trending equity position. It oscillates. It's basically a measurement of the emotional premium and volatility in the market. So it's a fairly safe contract to trade. So for those who are brand new to trading, this could be something to consider. Of course, I'm not your financial advisor, so make sure that you understand, especially with coaching, is I tell people, if you're going to start trading, start off small. You don't have to jump in with all your cash available and boom, take one position. That's not wise. Get your feet wet, kind of tiptoe into the pool and trade something that's fairly low risk and has a higher probability of making money. So VXX is looking good, and that's really the only symbol that I'm going to volunteer tonight, because I wanted to tell you the actual story and how this happens for people who are just starting out. Now, like I said, I'm going to start off for the subscribers to the Option Oracle. I'm going to start off with Amazon. Amazon, and for those of you who are not option traders, just bear with me for the next 4 minutes or so, because this is a very important position that that I reported on last week. Amazon, for the option traders, we sold the 705-710 call spread, and I did a special report on Wednesday to let everyone know, as a follow-up to the expiration week alert, what I was going to do, what my plan was for handling my position for Amazon. I did say that Amazon has a tendency of selling off on expiration or towards expiration, and it did just that. In fact, it got down to 704 on Friday, and right here, if you look, that low actually got down to 699.18. What I did, and I know not everyone did the same thing I did, but I said to everyone I was going to wait till Friday to adjust my position. What I did is I closed out of the 705s. I bought the 705s back when Amazon was trading 704. And I just closed the short side of the spread. So I bought the 705s and I let the 710s run. And so I closed the position out and salvaged a profit in that. Now I know some people rolled out, because that was one of the other choices, rolled out to July and do that for $1 debit. So in the next report, what I will do is I will treat that position as though I still have it, even though I don't, in an effort to help those who are still in the position so that we could eventually close that out for a profit and continue to take in profit. Amazon is really a wildcat of a stock. It absolutely is. The interesting thing is, although it was up $7.62 today, and here's my test question to all of you. Paying very close attention now. I'm going to be watching the chat box there. Can anyone tell me what that candle pattern is right there from Friday? What's this 2-day pattern? What's that called? Can anyone tell me? Let's see. Wait, I know there's a little bit of a delay there. Who can tell me what pattern that is from Friday? This red candle and this green candle. What is that? Okay. Let me see. Michael, you're right. Joe, you're close. Sophie, you're right. That's a bearish engulfing. Bullish would be the colors opposite. It would be green over red. This is red over green. So that's a pattern. You're correct. It is an engulfing pattern. Now, if you look at what's happening here, this Amazon price action is still in a downward leg. I'm not going to say downward trend, because a leg is a smaller or shorter version of a trend. This is a trading leg, and the leg is still headed lower. Now, there's also a gap below the market right here that's still unfilled. Amazon could very well go all the way down to 620, which is almost a $100 point drop in that stock before that gap fills. Now, once this gap fills, there's an 80% chance of the stock doing what? I referred to that when we were talking about NUGT. Oh, Joe, you're colorblind. Oh, well, be careful then. You might want to switch the charts to black and white then. Don't go with colors. But if once this gap fills down here, what is there an 80% chance of us seeing? Anyone want to throw that out there? Who wants to take a stab at that? Yes, Larry, you're correct. There's a good chance it's going to rally. Sal said good chance it'll reverse. Nathan said it'll go up. Sheldon, you said up. Yes, you're all right. Brenda, absolutely. So have the ability to put notes on your charts when you put a price alert. If not, then just make a little log or a note to your log. I would say watch for the price action to fill at 627, and then watch what happens to the stock after the gap fills. Again, there's an 80% chance that the price will reverse. And again, look at the history. Let's look at some of the gaps. Here was a gap up, very small. You see that back? The gap 3. Okay, here's another very, very small gap. 1, 2, 3, 4. On the 5th day, it's starting coming down. It filled the gap right here. This is where the gap is still left open. And that's all I'm going to say about Amazon. I just want you to have the hard evidence on the chart so that when you're following technical analysis, again, in its purest form through price and volume, you will not only see how reliable the charts are, but your confidence will start to build in your own ability, actually, to read the charts. And then when your confidence starts building, what happens? Your fear starts to drop, right? Fear actually is inversely related to your profits. We were talking about the VIX being inversely related to the S&P. Well, fear is inversely related to your profits. And there's an old saying that scared money doesn't make money. And that's true because people tend to get shaken out of the market because of the fear of loss. So what I tell people is if you have a good, strong signal, react to the signal, but prepare as though you're going to be wrong. And I know that sounds crazy. But what you have to do is imagine, okay, here is an 80% chance that it'll fill, but you have to prepare for the 20% of the time when it doesn't fill. You follow? So we always have to have some kind of risk management strategy in place before we even place the trade. And if you can continue to manage your risk, that's going to, again, boost your confidence because you know that when you are wrong, and you will be eventually, that you're not going to lose a whole lot because you're minimizing the loss through your risk management plan. Okay, so enough said about that stock and the major indices. What I like to do, I'm going to spend a lot of time answering questions today, and I'm also going to be taking some stock symbols. So Bruce has a question, what causes gaps to fill? Bruce, that's a really good question. On the Market Guys website, let me see if I could open this up for you. On the Market Guys website, I want you to, if you haven't looked at this already, I want you to go to the video tab. I'll go to the Market Guys, so www.themarketguys.com. And click on, again, it's slow to react. And I have a high-speed connection here through Bright House. So I don't know what's going on there. So go to the Market Guys webpage, click on videos right there at the top of the page, and it scroll down. This is a video library, and each video is called a market shot. It's a very short video, maybe 7 minutes max. you'll see there's a video link right here called Trading the Gap. Now, Bruce, you definitely want to review that because they do go over in detail what causes the gap and why it works that way. But in review, I'd like to give you a quick answer to your question. Now, remember what I said about people reacting to whether it be news or other price action, whatever it may be. Let's go back to NUGT because that is another stock that follows gaps quite regularly and quite accurately. If you look at this chart, you'll see that this has quite the volatility. Now, I would not suggest anyone trade this if you're faint at heart because this one could give you, as my grandmother would say, it could give you agita and cause you to lose sleep at night. But what happens is when a stock gaps up, it's usually a knee-jerk reaction to news. Now, Phil, that's part one. Understanding what causes gaps to fill starts with understanding what causes the gap in the first place. So let's say on this day right here, which was April 8th, news came out that the Fed was going to increase interest rates. Let's just say that's because that would actually cause gold to go up. But let's say on this day the news came out, Fed's going to increase interest rates, boom, knee-jerk reaction occurs, the market opens, gold goes higher. Well, the first day that the gap trades, you have more or less the market-minded individuals are reacting to the news. That's usually what happens. The people who are paying closest attention to the market will react to the news, but yet after a gap starts, there's a 90% chance that it will go higher the next day. See here, gapped up, very next day went higher. Now, why does that happen? Think about that for a second. You got to get into the market psychology here. Why does the second day usually see a continuation of upward price action? It's because those who are not on top of the market are reacting in day number two. They're getting the news a little bit later. So what happens is second day, people react to that news. Now you got to remember, by the time the second round of people get to jump in, the first group are already up and making profits. So here's what causes the gap to fill. If you bought in the day before because maybe you're anticipating your news to come out the very next day, and it does, you're starting to take your profits. And profit taking involves selling your stock. So in other words, the people who bought in and now faced with having to take a profit do just that. They take their profit. So they sell and they keep selling until it gets to the point where they first entered the market. And that's why the gap reverses, because those people who got in, some of which are day traders, are taking their profits. Once they sell out of their profits, they're no longer selling because they're not short selling, they're just selling out of profits. Then you have a new wave of buying that comes in. That's why you got that 80-20 rule. Because 80% of people that got in are now taking their profits. They'll push it down. The second wave are those who know that there's an 80% chance of a reversal. I know this is going to sound crazy and maybe even complicated, but those who trade gaps know that there's an 80% chance that it'll reverse, so they get into the second wave of buying. Boom, now they force it back up. So, Bruce, that's a long answer to a short question, but hopefully that helped you out. Okay, now Rick has typed in a stock symbol. Before you type in a stock symbol, please do what Rick has done and tell me what your position is. So just don't put a stock symbol and expect me to read your mind and tell you, what I think you should do. I'm not giving advice. I'm analyzing the stock, but it helps me help you better if you can tell me what you're doing. Now, Rick says, I have a long position a long position SNA that I add to when I can. I want to add here, will the gap at 170 fill? Now, Rick is referring to this gap up here. Well, Rick, here's how I'm going to answer your question. In the same fashion that I described the percentage of gaps. There's an 80% chance that that gap will fill. How about that? The good news for you is that if you are thinking about adding to your position, you see last week we had very, very close to a bullish engulfing pattern here. But let me see, this is Monday, Friday, Thursday, Wednesday, Tuesday, you had a hammer pattern. So right now, there is still a line of support that we can draw right here, right around 151. So be careful, Rick. If you're going to add to your position, you have to still manage the risk on the new shares that you currently hold. Now, if you're so inclined, please tell me what your cost basis is on that total position. That'll help me help you better. Because here's why. I think that there's a good chance that this could go up, and before filling the gap, there's a good chance it's going to bump its head against this resistance first. So chances are it'll get up to 164, 165, and then start to pull back. So if you're trading the stock, you might want to take any new positions that you're getting into at 152, 153. You might want to take a profit on some of those at 164 and bank the profits to help you lower the cost basis on the existing shares that you believe you're going to hold on to. And now, to help Rick out, I'm just going to go a little bit, I'm going to back out and look at the weekly chart, leaving those lines in place. See, there is a good chance that this could move back up to test that resistance. But Rick, if it does not break out of that resistance, then you have to really make some tough decisions on whether or not you want to stay into the rest of the position. Because it looks to me like this is almost a head and shoulders pattern. So you have to be very, very careful if it breaks down below this key support level right around 151. So let's see. Did Rick add to tell me what the cost basis is? Well, Rick, you don't have to, but it would be nice to know what your cost basis is on some of those positions. Okay, so let's go on and see who else has positions. All right, Larry says, what can you tell me about BP? Looks like a reverse pennant. Let's see, take a look at BP. Now, we made some money in BP because, you know, when the oil stocks came and got hit hard, BP, actually BP got hit really hard when ExxonMobil started laying off people in Saudi Arabia, particularly in Dubai and Abu Dhabi. And they got hit real hard out there. Let me just move this over so I can get to my control panel a little bit more. Okay. Now, here's the thing. Look at this, Larry. This is a weekly chart, okay? And this week, BP gapped up. Now, follow me here. When the stock gaps up, it means that there could very well be a magnet drawing it back down. BP, from the looks of this chart as I go back in time, it looks to me, let me just scan this before I make my comment. Yeah, it looks to me like 100% of the gaps that form on a weekly chart, looks like 100% of the gaps have filled. Even this one, gapped up right here, came back down, filled. So while you might be thinking, okay, let me buy into this, the weekly chart is saying, whoa, hold your horses. This is a gap up. But interesting enough, as I switch to the daily chart, look at all these gaps here now. Look what's happened, Larry. BP gapped up to a resistance point, and the volume is decreasing. See the highs? The volume is decreasing as the stock is going vertical. I would be very, very cautious about that. Again, you didn't tell me whether or not you have a position in that, but that would not make me comfortable comfortable taking a long position at this point. Now, for those of you that want to track whether or not my analysis here is accurate, I would suggest you take a screenshot right now. If you have an Apple or a Mac computer, you can hit Shift Command and the number 4 key, or is it number? Let me see. Is it Shift Command T? It's either Shift Command T or Shift Command 4. Take a screenshot of this, because here's what I think could happen with BP. Ready? I think this is what's going to happen with BP. It's going to do that. Now, you know, it could fill the gap, and you might say, well, that's 30, but, you know, what if it doesn't hold support here and it goes back down to 31? Now you're losing almost 10% of the stock's value, and there's still a gap below the. You got to watch out for gaps, especially in a stock like BP. Now, if you want to trade BP, you can do that. Or watch this. Let me show you something. GUSH. Has anyone ever heard of this? This is a great trading vehicle. It's called Gush, and it's the S&P Oil and Gas Bull. It's three times. It's leveraged 3 times. So you can see this is one that's a trading vehicle. It's not one that you want to invest in because it has huge volatility swings. But for those who are daring, this is another instrument that you might want to consider. Again, make sure you read the prospectus so you know what the risks are in this one, and it'll help you. Okay, let's go on, and let's see. Ron, being very Ron is asking for me to take a look at CNP. And his comments are, let me see, let me get this, CNP, it's an energy stock, looking for an entry point, do not own. Okay, now, look, here, Ron, I'm going to think out loud, and while I'm doing this, I want everyone else to understand how I more or less evaluate a candidate for a long position. Now, first of all, you have to look at this. Look at the trend from this low to this low. I can even connect this low here. You can connect this. Boom. Let's connect these 3 points. This low, and this low. Now, this is called a fan. I think I have a video on fan patterns. Again, I'm using basic technical analysis, but what I'm doing is I'm measuring the acceleration of the trend. So now, after my 3rd point of this existing trend, we're seeing higher lows. From here to here is a higher low. If I project that out from here to here, you can see that there is an accelerated trend. Now, I take the last point that my trend has touched here, and I connect that to another higher low. See the fan pattern here? Now, when you see a fan pattern accelerating in the angle in which the stock is accelerating in that upward rally, you have to be extremely, extremely careful, Ron. I personally do not like to buy stocks that are on the 3rd accelerated trend within the fan, because number one, you have an almost vertical move here. Please forgive, that's Twitter sending me. I still haven't figured out how to get rid of those. But we have an accelerated trend, and watch this. Ready, Ron? Can anyone tell me what this pattern is right here today? Who would like to volunteer that information? Who's been doing their homework? I know there's a delay, so I'm going to wait. This pattern right here, right there. Anyone want to take a stab at that? All right, let's see. Any answers yet? Okay. Oh, look at all the answers. Wow, Sophie, first one. Doji, Larry, Doji, Neil, Doji, Joe, Dragonfly, Doji, Sheldon, Kim, Doji, you're all right. What now? Again, for those who are brand new to technical analysis, watch. I don't know if you could see the answers. If you can, I'm going to read them to you. Watch how astute our audience really is. when you see a doji, can anyone tell me what that tells us about the psychology of the market? What does a doji represent? Sal, first one, it's a sign of indecision. Exactly. James, Jim, Andrew says uncertainty. Absolutely, all the same. They're synonymous. It's an indecision, a sign of indecision or uncertainty. That's number one. Number two, the doji was formed after 3 consecutive days of higher highs and higher lows, but, ready? This is how I analyze the stocks. This is exactly how I do it. I then look at the volume. Is today's volume higher or lower than it was on Friday? Can anyone tell me? All right, I'm going to answer for you, and I know the answers are going to come up. It's slightly lower. So when you have a stock that's going up on lower volume, that's usually bearish. It's telling us that the buyers are starting to run out of commitment or running out of buying power. Yeah, see, Craig, Brenda, Sandy, Sheldon, absolutely. So there's a good chance that this stock is going to do this. A very good chance that that's going to happen. Now, look what's happening right here. In fact, I could extend this line. Let me erase that, and I'm going to do this so you can get the screenshot. This is my forecast for this particular stock right there. There's my target. My short-term target is the gap fill point right there. 80% chance the stock is going to break down below this accelerated fan line. 80% chance that fill the gap right there, and then we'll have to determine whether or not we get a bounce from there. So, again, long answer to a shorter question. Is this a good time to buy? I would hold off on that one and wait, Ron, to see whether or not it bounces off of that gap point, the gap fill point. Okay? All right. Let's see. Sheldon, is that a question? January strike. I don't know what that means. Oh, okay. Okay, that's what you were talking about. All right, now Andrew, SLV long January 17 calls on June 3rd. Okay, let's look. Now again, for those who are not option traders, bear with me. When you buy a call, I really should throw a disclaimer out there. Don't trade options unless you've gone through a course of some sort, because options could be risky if you don't know how to trade them. So there's my disclaimer. Don't go out there. This is being recorded, so especially for the people who are listening to the recording, obviously the charts aren't going to match your current charts. But let me first disclaim, Andrew, I sold out of every single bit of my silver position right here. I sold out on this day because that's a huge bearish engulfing pattern. I sold out of everything on Thursday. On Friday, we have a perfectly formed doji. Again, a sign of indecision. So let's analyze it step by step. You see a bearish engulfing pattern. Obviously, there's some commitment on the sell side, followed by a sign of indecision, followed by a major drop in volume here on the way up. So all arrows are pointing to the lower level. So, Andrew, if you got in on this one on June 3rd, you're obviously making a profit. So there's an old saying, you can't lose money taking profits. That's number one. Number two, you're long a call that will start seeing some time erosion. So again, what I'm doing is I'm waiting. I have a buy order to buy all of my silver position back at 1568. That's where my buy order is. That's right at that gap fill point. I have a very large position I'm looking to buy into, and even though there's a gap below the market here, I don't want to be out of the silver market. The reason I sold is because the bearish engulfing pattern and the signs are showing negative, but I'm looking to build my share number, the number of shares. So what I do is when I sell out, I'll buy back more shares, because I don't want to say I'm day trading, because I'm certainly not day trading this. But when silver gaps up, I'm trading in my retirement account, and I can't day trade a retirement account. You'll get slapped for day trading charges and violations, and you don't want to do that in a retirement account. So I am looking to accumulate more silver, because eventually, again, these are my personal opinion, I believe, look at the monthly chart, I believe silver could eventually get back up to $40, maybe $50 an ounce. I don't see any reason why silver cannot get back up to these levels. Because look what I'm being pretty conservative that within the next 3 years, and again, I'm being conservative, within the next 3 years, silver could be trading $40. And again, conservative. It could go up a lot faster in 2010, but I'm being conservative. And you can see that silver on the monthly chart is showing a pivot point, hence the reason why I don't want to be out of silver. I don't want to be in cash too long, because the longer I sit in cash, the greater the risk of me missing this upward move. So hopefully, Andrew, that's helped you with your decision there. Again, see, I'm able to make comments like this because we're in a group setting. I'm not making individual recommendations for you. We're analyzing these stocks. We're learning about the charts. We're, again, teaching people how to react to certain signals and such. And I think that could really help every single person on this call today. All right, now Philip says QQQ. Now let's go back. Being that I'm on the monthly chart, Philip, watch this. QQQ. I'm going to hit the power shares and look at the monthly chart. I want you to watch this because you got to be really careful of this one. Does that look scary or what? Now, why does this look scary to me? Because if you analyze remember I talked about fans, okay? Here, from this low, you have this trend. Then you have an acceleration from here to here. And that's this monthly chart, okay? You have a monthly chart. Come on, why isn't that picking up there? All right, hold on. My charts are going screwy here. Remove that. Watch this. This is on a monthly chart. I'm going to connect that low to this secondary low. And then what I'm going to do, zoom in, is I'm going to take this low and go to this low. Look, that's pretty scary for the Qs. That's number one. Number two, once this third accelerated fan line breaks, you're now going to start to see lower highs. But until then, the Qs have been going up, almost vertical here. Look at these lows. But look at this volume. See, Philip, this is why I am not rushing into any major market long positions. I don't like the way this market feels at all. Now let's leave these lines in place as I go to the weekly chart, because you can see that those fan lines will hold. And once again, this gap has filled. Look, remember the rule for gap trading? Here was a gap down. It filled. As soon as it filled, 80% chance it dropped. It did drop. And now we have the potential threat of a fan line acting as support breaking. So if you're looking at this on a price scale, this price could easily drop to the second level of support, which is going to be the second fan line. Now, it doesn't look like much, but that could be, that's a drop from right around 108 to 102. That's about a 5.5% drop in price just by looking at the charts. So that's why I say don't go jumping into any long positions here. You're saying in your comments here, considering going long stock and or calls, I would second guess that. I would take another look and say, you know what? Let me wait with patience and see what happens here. You know, another thing, folks, on the tangent, when you get into the 8th year of a presidential cycle, if you go back in history and look at even George Bush Sr., when he came in, that was when you look at Reagan, you look at the end of Reagan's term, the market had a terrible, terrible year. The presidential cycles is something you have to keep an eye on. And with all the uncertainty out there, what the Fed is doing, I have no idea what the Fed's doing anymore. I really don't. I mean, we're on the brink of going negative interest rates here. But I really don't think that we're going to see anything so dramatic that's going to cause these major markets to go back into a bull session again. In fact, the next president, whoever he or she may be, might be faced with one of the most incredible recessions that we've seen since 2008, 2009. So again, I'm not trying to scare you out of the position, Phil, but you got to weigh the evidence and say, okay, what's my risk, what's my reward? And from the looks of the charts, it looks like everything's pointing down at this particular point. Okay, Sandy, I'm so sorry. This particular platform does not give me stocks that trade on the TSE, so I'm going to have to skip on FM. If you have another U.S. stock, then please submit that. Okay, now PB has wants me to comment on UPS, and UPS very interesting because UPS has been quite a volatile stock. You'll see here in a moment. This has huge price swings. It's a great trading stock, and PB says, is UPS too high already to contemplate going long? Well, again, let's take my opinion out of the equation. My opinion and your opinion, not to offend anyone, but our opinions mean very little because opinions are usually filled with emotion. There's got to be some kind of an emotional tie to an opinion. But when I look at, again, the hard evidence, this is a 3-year weekly chart, you can see that UPS is right at a level of resistance. That's number one, resistance. And if you look at the highs for UPS, the highs are consistently dropping in volume. I'm just connecting the highs like I would in a downward trend in the stock price. So we have prices going up from back here in January of this year. Prices have been going up, but the volume is dropping. And we're starting to see shadows above the weekly candle. Follow me here, okay? PB, hold on. I'm letting my chart zoom in. Oh, come on, that chart. I know you could do it. Let me move this over a little bit. I think I'm in the way of that. Okay, there it is. All right, come on now. I know we could do it. All right, let me go to the daily chart. All right, now, this is the daily chart. Again, that line held, and you can see that today, UPS gapped up. I see a gap below the market. That does not get me a whole lot of points when I'm looking at a buy candidate. Because again, if you look at UPS, don't just take my word for it. Look at history. Here's a gap up. It filled. Here's a gap down. It filled. Here's another gap up. Minor gap. It filled. Here's a gap down. It filled. Here's a big gap down, and it took months for it to fill. But when it finally did fill, what happened? It reversed. Here's a gap. It filled. Then it reversed. There's a gap below the market with a candle that has a long shadow above the market. Here's my price forecast for UPS. Again, not based on opinion, based on technical evidence. So, if you want to take a screenshot of this, go ahead. And again, it's not to brag about how accurate I am as a forecaster. I'm doing very little with regard to predicting the future. I'm not doing that. I'm just reading the signals and its probability and outcome. This is basic statistics. If I see that there's a high probability that the gap will act as a magnet, then chances are it'll go back down to that point. And who can tell me why I drew the angle the way I did? Who's been paying attention to the weekly market reports? Who wants to answer that one? Why did I draw the angle that way? Or what caused me to draw the angle of my pullback to that point? Who wants to guess at that? Ah, Nathan. Yes. Joe. Yes. Larry. Yes. Charles. All of you say past angles. Larry said the last angle down. Watch. Let me show you. See this? From there to there. There's my angle. Right? From here, from this high to this low. I'm drawing speed lines. Right? From this high down to that low. See the angle? If I had a protractor, you would also agree with me that these are the same angles with regard to the pullback in the stock. That's how I've been getting so accurate, is because I've been drawing shorter speed lines or trading legs based on past angles and past performance. So when you analyze the type of candle and compare that to volume, and you can see that the volume has been steadily dropping here too, that can give us an indication of which way the market is going to go. And and you have a very strong probability that it will move to that direction. So again, take your copy of the screen. For the members who are subscribers to our trade alerts, you're going to get the recording of this, by the way, on your member page. Tanya Shanley is nice enough to record this for us. She's in the studio right now recording. That will go out to all the members. If you're a non-member, then I would suggest you take a screenshot and then put a price alert on UPS so you can track this. All right, let's get back on track because I can't believe how quickly time is passing. All right, let's see. Where was I? I left off with PB. And let's see. Who did I not get yet? Let's see. I'm trying to pick somebody that has a stock symbol. Okay, here, Gloria. Gloria Gomez. Oh, I hope it's okay I mentioned your last name, Gloria. How do I read GLD trend? Okay, that's fair enough. If you don't have a position, that's okay. I can look at GLD. Now remember, I was looking at silver already. Silver and gold have a tendency to trade in direct proportion to one another, except gold is a little bit more volatile. I'm going to erase all lines. Now, this is a one-year daily chart. You could see that the up legs, see this? Look at the angle from this low to this high. See that? Let's go from this low back here to this high. You see the angles at which these up legs are moving? Look at almost parallel. Look at that. See? Well, how do we read the current chart? Look back at what happened on Thursday. Bearish engulfing pattern, just like silver. That's the day I sold out of silver. Followed by a small green candle with a lower high. That's a half signal. And in review, what I talked about at the very beginning, on lower volume. Okay, so that's a signal that this is a pivot point forming. Now, I could go back and look at the past angle of downward legs, and I'm going to basically go and do the same thing. Boom. And I'm going to stop right about there. Why am I stopping there? Because that would be the first gap fill point. I think gold could go even lower than that, but here's what will most likely happen. Once that gap fills, and I'm obviously speaking with confidence because there's an 80% chance that can happen, I think gold could do this. Boom. 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 That's what I think gold is going to do. Now look at that. This is kind of putting my neck out there with regard to forecasting the gold markets. But I've been trading gold markets for almost 34 years along with silver. This is how gold trades. Now, if you look at why I stopped here, okay, hopefully, Gloria, this is helping you out. It's because gold is in a very well-defined trading channel. I don't want to overcomplicate this here, but I could say there's your trading channel for gold. There's a chance that it's going to do this little bumpy ride to fill the gaps, but once it hits its major support right around 115, it's probably going to make another run up like it did in the past when it bounced off of that very same support level. You see that? So that is, in a nutshell, how I analyze the markets. Very reliable, very accurate. I'm still tracking the best percentage of accuracy in the world, and I am looking for others that have over a 90% accuracy rate. And I would very much enjoy your company in discussing market forecasts because, like I said before, if we can get a group of people that are extremely accurate on a regular basis, that becomes a team that's just unstoppable, folks. And imagine what we can do with regard to our talents there and helping people. But I think that these are going to be pretty strong forecasts. It is recorded. I record everything I do so we can go back and learn and review from that. And so that'll help you out. Now, I have 1 more minute to make my final announcement. Like I said at the very beginning, please tell as many people as you can about what's going on here, because if you can turn people on, especially to the videos, these videos are free. This is free education. Very few people are giving out free anything these days. we are giving out the free education because we're trying to create a global awareness, not just in the US, but we are trying to build the audience to react to the signals that are very obvious here once you've studied them, of course. But once we have a mass audience that's continue to follow when we react, we all benefit. The bigger the group, the more accurate these signals become, and that in turn translates to more profits for all of us. Again, I want to thank everyone for taking 1 hour out of your early evening to join us. I hope you had a good time. I hope you found the value. I get so pumped up about it. Can't wait for the next one. I will get with Bill Shanley, my partner, and we will post the next open house Q&A down here. So I would give it just a couple of days. Then you could register for the next one, and it'll send you a reminder so you can save your seat. We had a lot of people on tonight's call. So again, I hope you enjoyed it. So folks, have a great night. We'll talk to you soon. So long.
For almost 3 decades, A.J. Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is A.J. Monty, Chief Market Strategist for The Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our Trade Alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have 2 services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for the Market Guys. Thanks for watching.
Enrolling in the service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.